thing called canned heat, which is an indoor safe fuel. It's completely off-grid, and it can heat up a 200 square foot room in a matter of minutes. With a Vesta stashed in your closet, you can rest easy, knowing you and your family will stay warm, even if the power goes out. Plus, it doubles as a stove to boil water or cook food without electricity or propane. The best part is, you can get a Vesta and a bunch of other free gifts when you order the Winter Prep Special from My Patriot Supply. Just go to MyPatriotSupply.com to see everything included. This offer won't last long, and neither will this nice fall weather, so go to MyPatriotSupply.com today. That's MyPatriotSupply.com.
My name is Dale Pazinski. I volunteer with United Way to help the homeless in my community learn computer skills and build a basic resume. I don't just wear the shirt, I live it.
Give, advocate, volunteer, Live United. Go to liveunited.org. Brought to you by United Way and the Ad Council.
This is the Money Matters Radio Network, WBNW 1120 AM and W275CM FM, Concord, Boston. The Money Matters Radio Network.
October 24th is National Food Day, a perfect time to celebrate fresh, local food right here in Massachusetts. Fall harvest season is in full swing with crisp apples, sweet pears, pumpkins, squash, cranberries, and hearty root vegetables at your neighborhood farmers market. Markets are still open, so grab your bag. Support local farmers and bring home the flavors of autumn. Sponsored by Mass Farmers Markets, helping grow farmers markets across the state. Find your local market at massfarmersmarkets.org.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month titled Understanding Required Minimum Distributions. Mike, a lot of changes in the RMD landscape. When do people have to take RMDs from either IRAs or Roths?
How old are you?
Me personally?
So this does start changing now. It is currently 73 for a lot of folks. For some younger folks, it's actually now going to be 75 years old for your traditional IRAs and 401ks. And so that started at 70 and a half just a few years ago. And so this is a new set of rules for a lot of people.
When you look at how the penalty situation has evolved, this is one area that's actually gotten a little bit more lenient in recent years. And so that's something where if you are new to RMDs, there are some incentives if you've missed one to get that squared away as soon as possible.
There are, but, key takeaway. Understand these rules and don't miss your required minimum distribution because there are still penalties for something that, again, is completely avoidable. Yes, the penalties used to be bigger. They are less less stringent now and a bit smaller, but it is still unnecessary extra taxes and fees that you will end up paying if you do miss your required minimum distribution. So get our guide and learn a little bit more about how all of this works.
Folks, the guide is titled Understanding Required Minimum Distributions, and there are two ways that you can request it. The first is by calling 800-393-4001. The second is by visiting ArmstrongAdvisory.com. Again, that number is 800-393-4001, or you can request it online at ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We pride ourselves on being able to support veterans in their time of greatest need, ensuring they receive the protections they deserve. For over 100 years, the DAV of Massachusetts has helped thousands of veterans with housing, transportation, and medical assistance, and you can help too. Please visit dav5k.boston and make a donation today. That's dav5k.boston.
The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
I believe that's us, Marc.
Well, I hope so, because I blocked off the next 2 hours.
Well, even if you didn't, we've got your AI likeness in studio with us. It's Chuck Zodda, Marc Fandetti AI, and we are here to tell you about what's going on in markets and in the economy today. We kick things off with a piece from Barron's titled American Corporations Are Crushing It. This stock rally isn't just about tech. And to cut to the chase in this piece, data from LSEG show that expected year-over-year Q3 earnings growth for Mag 7 tech titans is 14%, but performance is broadening out with an estimated growth of 7.8% for the other S&P 500 companies, a much narrower gap than in recent quarters. Your thoughts, Marc?
Oh, crushing it seems a little overly enthusiastic. It's solid. I'm talking about the 8.5% growth from this source and from earnings data provider FactSet. They estimate similar year-over-year earnings growth for the period ending September 30th. Stocks are up twice that, though. So one way to interpret stocks being up twice what earnings are up is that the willingness of investors to pay for future earnings has gone up faster than earnings themselves.
Sure.
Said differently, price to earnings ratios, and I'm using the trailing 12 months PE price to earnings, and that's just what it sounds like. It's a fraction. You can use other metrics to come to the same conclusion. Investors are presumably pleased with these results, but their future assumptions are even more heady. So if those aren't met, it could be a problem for equities. But I guess we should celebrate a year of reasonably solid earnings growth.
Yeah, I haven't done the numbers myself on this, but I'd be interested in seeing. So this separates Mag 7 from the rest of the S&P 500.
That was helpful, them doing that. Yeah,
it is. But okay, like what happens if I include Broadcom in here, which is not Mag 7, but is a huge contributor to earnings growth, both because of its size in the S&P 500 now, and the area that it represents, which is AI adjacent. What happens if we include Oracle, which has been, a darling over the course of this year as well? What happens if that gets, kind of included in that bucket there? So I think that the message that I do think is out there is, look, the overall picture for the other 493 companies in the S&P 500 is not bad by any means. It simply is, I think the best way to describe it is in line with historical norms, which, like, if you look at earnings growth in the S&P 500 historically, generally averages around 7% a year.
Oh, yeah.
And if you're within a couple, percentage point or so of that, yeah, there's nothing that is a huge issue on that front. And the U.S. economy, despite a number of questions this year, has remained incredibly resilient to this point, and continues to show corporate profit growth that is, I think, quite honestly, in excess of where a lot of people thought it would be at this point. If you asked them, in Q1 or early Q2, hey, what do you think is going to happen with earnings this year? I think a lot of people would have said, yeah, they're going to get, worse and challenged because of tariffs and this and that. Yeah. Some of that's mitigated by the fact that the worst case tariffs were pulled off the table, but companies have done a really good job of trying to navigate them as well to this point. Now, this is the place where you get to the question of, are corporate earnings the U.S. economy? And the answer is obviously no, because we do talk about quite often, hey, even though corporate earnings look pretty good right now, household earnings, there's some questions about, kind of where that picture's going for, in particular, the bottom 50% of incomes in households. So I think that, you can kind of have both these things happening at the same time, where you say, look, households are struggling because job creation is weak, inflation is still running around 3%, and it's kind of hard for households in a lot of cases to get by with that situation. But companies are doing well because part of the reason that inflation's at 3% is that they're able to raise prices a little bit in order to maintain margins, and demand is still really strong in the aggregate. I know we've talked about, housing being slow in a couple areas that have slowed down, like restaurants, but aggregate demand continues to just hum along, and so these two things can be reconciled, I think, especially when you put in place the third thing that we've talked about a lot, which is, hey, a lot more spending is being driven by the wealthy, and that's more asset-based spending. And if portfolios are up as they are this year, that's not really going to be impacted.
Yeah, I think there's a tendency, I certainly fall into this trap of looking at the performance of the stock market. And although company, which is driven in turn by company earnings as well as investor expectations for future earnings, so there's that PE multiple so-called expansion component that we talked about earlier to stock market performance, but you can be fooled by a strong stock market. You can be fooled to the extent that you infer that means everything, that the gains from economic growth are being reasonably widely or broadly distributed. They clearly aren't. And I don't know what to make of Marc Zandi's statistic that the top 10% of the income distribution accounted for about half of total spending in the second quarter, a number that has been climbing relentlessly going back nearly 4 decades.
It's not good societally.
No.
We know that. And look, it's the big thing in the United States and pretty much in any successful country anywhere, you never have a situation where the top 10% of earners are spending like 10 to 20% of, all spending. In the U.S. historically, like if you go back and look at the historical data that they've pulled on this, it's typically somewhere in the mid-30s is kind of where that concentration is. The top 10%, spent, 35 to 38% of all consumer spending. That's even like if you look back at, times where we've said, hey, this is a good economy and people are able to, find their way economically, you still had, a skewed spending by that top 10%. I think the issues that we have right now are twofold. You could even say threefold, quite honestly, with how things are setting up. The first is it's very clear that you get to a certain point and it's just like, hey, so many people just feel economically left behind because they're not in control of their economic destiny. Which dovetails into the second piece that I hear a lot from people in their 20s. I try to make an effort to talk to, people in their 20s a decent amount about this stuff because, you think about it, and it's been 20 years since I was, someone young, coming out of college, basically. And the world is different now. I know we always like to project kind of our past experiences and like, well, why can't you just do like what I did when I was younger? Man, when I was younger, it was a different world. Like, the iPhone had barely just come out. Like, it was not the same world. So the people that are 23 today are living in a different world than I was at that time. And I realize that. And you talk to people at that age, and it's not just, hey, I'm not making much, but the path to being able to make it feels narrower to them. I don't know if it actually is or is not. I don't know if there's less upward mobility today than there used to be, but it feels like it to them and to a lot of their friends. I don't know if it's true or not, but I know that it feels that way. And the other piece that then that kind of the third piece that I pulled together there is there's also this looming threat of AI that everyone talks about. And so I think a lot of young people are also feeling, hey, if I don't make my money now, I'm not going to have a chance to because AI is going to just take out everything from a job perspective. And this is partly why I think a lot of people in their 20s are doing these financially reckless things like, running up, big gambling debts and prediction markets and all this stuff that we look at and we're like, hey, that's not safe. And they're like, yeah, what's not safe? Not being able to pay my rent is kind of the message that they give me.
Yeah, interesting.
So
I don't know what to make of it.
I don't either, but I realize that it's going on, and it's happening. I'm not saying it's good, bad, or neutral. I'm just saying that it's happening, and it doesn't feel like it's a healthy place for us to be. Let's take a quick break here. When we come back, let's talk a little bit about what we are seeing in gold right after this.
Text us 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we're covering. This is the Financial Exchange Radio Network.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com. Cushing & Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide, Making the Most of Gifting Assets, shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure or legal issues like a divorce. The guide also explains how a major gift, like a home or vacation property, could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing & Dolan. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
This year's DAV 5K is sold out, but you can still help our great American heroes. The race is Saturday, November 8th at Castle Island, and you can visit dav5k.boston to make a donation of any amount to support our troops. Your gifts help fund free rides to medical appointments for veterans and the nation's first DAV-led housing initiative, providing homes for single veterans and veteran families. Go to dav5k.boston and make your donation today.
Gold has been the focus of investors over the last couple of months. Since late August. Gold didn't decide to do anything. It's not sentient. It doesn't wake up and say, oh, gee, I'm a gold rock. Let me go do some stuff today. I don't know why it sounds
Probably
like
what
that
it would
either.
sound like, though.
You think it would sound like that?
I do. Sluggish.
Sluggish?
Yeah. Sort of slug. Because it moved. As we were just
You're
talking about
picturing
off
more
air.
like the Ents from Lord of the Rings, like, oh, I'm gold. I need to go.
Yeah.
I think it's a little bit more peppy than that.
Okay.
You know, I don't know.
But
I'm picturing it kind of like, look, you and I are both Italian. I'm picturing it kind of like a gold chain, you know,
you're
like
thinking of the Italian horn.
I'm going there.
The badass Italian.
I'm going there with it. You know, it's like, hey, I'm a little bit of gold. You want some of me? Yeah, of course you do. So, in any case, gold went on just an absolutely torrid rally, up, almost 35% from late August through late last week. And it has now promptly fallen on its face in the last couple trading days, down, 8-9% from that high. And so investors, are kind of looking at this like, okay, like what comes next? Like, where does this go? And the answer is, look, I have no idea exactly what gold is going to do over the next week, month, or, couple months. But what I can tell you is historically, I talk to people about this a lot. Investors want to hold gold the way they should hold stocks, and they want to hold stocks the way they should hold gold. What I mean by that is if you look at the long-term track record of stocks, basically the conventional wisdom and what the data shows you is, you don't really know where U.S. equities are going to go in any day, week, month, or year. But if you look at the long-term track record over 10, 20, 30-year rolling periods, you basically should hold those stocks and not do anything with them as long as they fit your risk tolerance and personal situation.
Sure. Totally different.
Buy them, hold them, sit on them, whatever you want to do. But what do people want to do with stocks? Hey, I'm going to trade in and out. I'm going to zig when they zag. And most people, quite honestly, aren't very good at it. You know, it's just most people are not winning stock pickers, especially when you factor in things like transaction costs, taxes, all that stuff. Most people are not winning stock pickers. They're just not. On the other hand, gold. People say, well, gold's my insurance policy. I got to hold this forever in case it hits the fan. Like this is something I'm holding forever. And if you look at the long-term track record of gold, it's basically punctuated by these bursts of just tremendous price growth over short periods of time, and then long periods of time where it does absolutely nothing because it's not an accretive asset in any way, shape, or form.
Right, which is exactly what you'd expect from a form of insurance. You
Correct.
you bleed, and then eventually, if things don't go well, but you're glad you've got it, it pays off. And that's the way to think about gold is distinguished from generative, as you say, assets like equities.
Which the wild thing is, you talk to people about their insurance company, and they're like, can't stand my insurance company. Hate it. All I do is give them money. And yet people talk about their gold, and they're like, this is my pet rock. Would you like it? Yeah, like it's just kind of wild. Like they even though it is insurance that provides them no tangible benefit on a daily basis, because if you're just sitting there looking at your gold, does it actually do anything for you? No, it doesn't. It is an insurance policy.
Well,
but people love looking at that insurance policy.
Yeah.
No one loves looking at their thing from, so-and-so mutual and being like, got to pay that premium again.
Yeah, and I think that actually makes a lot of sense. How much gold a long-term investor should own depends on their risk tolerance. Maybe they don't think they need insurance against whatever you think gold provides a hedge against: geopolitical turmoil, bad policy, tariff uncertainty, an outbreak of inflation, dollar debasement.
I thought you were going to say cholera or something like that.
Or the traditional outbreaks. So we all have something slightly different in mind when we think about gold as a hedge.
Yes.
Like the scenario you're hedging against is a little different than the one I'm conjuring up, probably.
Right. I don't believe in it as end of the world insurance.
Well, yeah, because it's not really marketable and in the
and
end
it's
of the
not
world
useful
scenario.
Then. I always say, look, if you really think the end of the world's coming, you want plenty of arable land, lots of animals, maybe a little bit of high ground, and the ability to defend yourself. Gold provides you none of those things.
No, probably not. It's not easily marketable.
And by the way, once people find out that you have a lot of it,
then
not great in the end of the world situation
totally
either.
Screwed, yeah.
I know everyone likes to think they're going to be the winners of the Mad Max scenario. I will tell you, I would be the loser. I would not be the winner in the Mad Max scenario. So I don't try to pretend that I would be.
But I struggle with this issue of should an investor, a serious investor, own gold? And part of it depends on your frame of reference. I started working in the 90s. Gold had been a horrible investment since 1980, and it continued to be a horrible investment for the next several years. And I remember telling institutional investors at the time, you don't need it, you don't want it, it's not generative. The same things we would say about Bitcoin today.
Sure.
But there are periods, as I think you put it very well, there's long periods of nothing happening, punctuated by periods of a lot of excitement in gold.
And this year has been one of them.
Yeah, it has been. So, but this neither makes the case for nor against gold. It doesn't help. It doesn't help me at all as an analyst, unfortunately.
No, but I do think it's one of those where it comes back to that fundamental question of, hey, if you're putting something in your portfolio, whether it's a precious metal, an equity, a bond, a private credit instrument, fart coin, whatever it might be, whatever you're putting in your portfolio.
Like an adolescent.
Listen, we realized by accident like 2 weeks ago that fart coin actually exists.
Yeah.
Yeah,
he's a millionaire. Whoever started it. Yeah.
Jimmy Fart.
Yeah, Tony Fart.
Yeah, he's. Oh boy, no, it's fine.
Such a good word.
Whatever is in my daughter learned how to spell it this week. I'm not kidding. So we're out to dinner the other night, and we play. She's 5, but she loves to play hangman with 3 and 4 letter words because she's trying to start putting words together. And the first word she does it's a 4-letter word. I'm like guessing letters. And the last 3 are ART, and so naturally I guess C. And I'm like, she's like, no, it's not C. And I'm like, is it F? And she's like, yeah, I spelled fart. I'm like, how did you do that? You're 5 and you're spelling fart in Hangman.
It's a proud moment.
It was a great one. But in any case, everything in your portfolio has to have a purpose. Understand why gold may or may not be in your portfolio according to your purposes. Quick break. Wall Street Watch and Ask Todd are next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting ArmstrongAdvisory.com. That number again is 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutsky, a partner with the law firm of Cushing & Dolan, with their master's in taxation. And today we're talking about the implications of gifting assets away. Todd, if you're trying to protect your assets from the cost of long-term care expenses, what are the risks in giving your assets to a child rather than transferring them to an irrevocable trust?
Yeah, it's a very big difference, right? These irrevocable trusts that we do for Medicaid purposes, first and foremost, are incomplete gifts. So you're not actually making a gift at all when you put it into these trusts. But if you give it to a child, now you've made a completed gift. So, for example, if I gave away my house, and people do it, right? You are giving away the built-in gain in that house. You now don't have any control over the house. You can't sell it and buy another one if you want to move. You need the kids' permission for all of that. Plus, if you never sell it and you die, you've trapped the built-in gain for the kids. When they go to sell it, they're going to have to pay capital gains tax. Whereas if you keep it, you can control it, get a step up in basis for the kids when they die, and still protect it from the nursing home through the trust. Either way, it's going to take 5 years. But gifting isn't always the answer.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy on their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, as third quarter earnings season ramps up, markets today are pulling back in negative territory. Right now, the Dow is down by 0.3% or 133 points. S&P 500 also down 0.3% or 21 points lower. NASDAQ down 152 points, about 2/3%. Russell 2000 is down over 0.5%. 10-year Treasury yield up 1 basis point at 3.974%, and crude oil up over 2% higher, trading at $58.51 a barrel. Netflix reported third quarter earnings that missed street expectation, while its revenue matched estimates. The streaming giant cut its extended operating margin for the year to 29% from 30%, citing an expense related to a dispute with Brazilian tax authorities. Netflix sinking over 9%. Following up on a developing story where CNBC is reporting that Warner Brothers Discovery rejected 3 Paramount Skydance offers as it fields broad buyout interest. Yesterday's report said Warner had received unsolicited interest from multiple parties. That stock today is up modestly. Meanwhile, Beyond Meat is the latest meme stock with wild gains continuing this week. Yesterday, shares in the plant-based meat alternative company rocketed 140% higher after it signed a deal with Walmart to expand distribution. Earlier this week, Roundhill Investments added the stock to its meme stock ETF. Shares today up another 100%. Elsewhere, shares in Intuitive Surgical jumping 16% higher after the maker of robotic-assisted surgery systems beat third quarter earnings expectations. Mattel down by 2% after the Barbie maker disappointed with its third quarter earnings, citing tariffs impacting North American sales. And after today's closing bell, we'll see anticipated earnings from Tesla. I'm Tucker Silva, and that is Wall Street Watch.
This is Ask Todd on the Financial Exchange Radio Network. If you have an existing estate plan or are in the market for one, Todd Lutsky is here to answer your questions and help you plan for later life. Ask Todd is presented by Cushing & Dolan, serving Massachusetts and New England for more than 35 years, helping families with estate and tax planning, Medicaid planning, and probate law. Visit CushingDolan.com. Now, here's Todd Lutsky.
Todd Lutsky from the law firm of Cushing and Dolan joins us now in studio, and he's here to answer your questions about your estate plans. We got the phone line open at 888-205-2263. The last couple of weeks we have not been able to get through all of your questions, so if you do want to have your question answered by Todd, get calling early and often. Again, 888-205-2263 is the number. One more time, that is 888-205-2263. The segment is Ask Todd, so you can ask Todd your questions. Mr. Lutsky, how are you doing today?
I am never better. How you doing?
Pretty good.
Uh-oh.
Pretty good.
Yeah, only pretty good?
I went on a date with a matador the other day.
A matador?
Yeah, it didn't work out.
No?
Too many red flags.
Yeah, definitely.
Yeah, real problem. Todd, want to talk to you a little bit about estate tax thresholds today.
Okay.
Federal limit right now is currently just under $14 million. Is that right?
Yeah, $13.99.
What's it go to next year?
So January 1, 2026, it's going to jump up to $15 million even.
that makes the math easy.
It does. So for a spouse, you could shelter 30 million.
So what I want to hone in on today, the number of states that have a state estate tax. It's not particularly high, right? It's like high single digits, low double digits, like somewhere around 10 states have them.
Yeah, it's a little higher. It is double digits, but I think it's 15.
And most of those thresholds are significantly lower than the federal limit, correct?
Yes, I don't know if I can say most, but we can at least...
A number of them.
Yeah, a number of them could be lower. Like Massachusetts is the worst.
So I guess here's the question that I have. People that fall above the 15 million, we talk about, what you can do in those situations quite a bit. People that might be, on the borderline of a state estate tax threshold, a $2 million estate, $3 million, we talk about those a lot.
Yeah.
How does someone who kind of falls like right in the middle, like... Again, high levels of wealth, $8 to $12 million estate, so no federal issue.
Right.
But they might have a sizable state issue that they need to deal with. What kind of tools are out there to help mitigate those and work through those situations?
Yeah, that's perfect. I mean, the answer you have there is, first and foremost, you still need your trust. You still need at that level, you're looking at a revocable trust, probably a joint revocable trust. Probably don't need two. And you need it. Why? And I'm assuming, Chuck, that we're in a state with a state estate tax, right? Not just federal.
Yes.
State estate tax.
Yes.
So I'll just use Mass as an example with the $2 million exemption. And so first, you need the joint revocable trust simply to obviously avoid the probate. And I say take care of federal estate tax. And I know you're saying, Chuck, the exemption's going to $15 million. This client is maybe worth $10 million, somewhere in between there. Why do they need to worry about the Fed? Well, it's not that you need to worry about it, but when you do the trust planning, you're going to shelter whatever the estate tax exemption is in effect when you die. Again, come a new president right down the road and new regimes in office, that exemption could drop. We can't necessarily assume it's going to stay at 15. It could fall to 7.
Okay.
And so you need to be mindful of that. So you need to do planning just to make sure that you grab whatever the estate tax exemption is. And plus, for portability reasons, if you die when it's high and you leave a spouse, you want to make sure you capture the unused exemption for the surviving spouse, so that in case they really lower the exemption for when the surviving spouse dies, she will have that unused exemption as a coupon in her pocket to take care of that. For Massachusetts or other states that have a state exemption, we want to make sure we double the $2 million to $4 million. At least do that. So if I'm at $10 million, I'm sheltering $4 million. But to your point, we still owe $6 million. Is there something we can do for that? Yes, gifting. Gifting is an option, perhaps. Moving, of course, is always an option. But gifting is an option. But then you need to really analyze the gifting. Am I going to gift high basis, low basis assets? The big deal here is that you got to make sure that you're not just, when you make a gift now, in this situation, you're not saving the 40% piece. You're only saving the mass piece. And if mass is at 10%, I don't want to give away something that traps capital gain at 28.8%. So think about what you're going to gift, but at least that's a little guidelines for you.
Talking with Todd Lutsky from the law firm of Cushing & Dolan. Phone lines still have room on them at 888-205-2263. That is the number to call to ask Todd your estate planning questions live on air right now. Again, room on the phone lines at 888-205-2263. This is your chance to ask Todd your estate planning questions. We're going to take a quick break, but when we come back, we'll have more Todd and your questions right after this. That phone number is 888-205-2263. Again, it is 888-205-2263.
Ask Todd with Todd Lutsky every Wednesday at 10:30, only here on the Financial Exchange Radio Network. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed superb nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing and Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
You're listening to Ask Todd with Todd Lutsky on the Financial Exchange Radio Network.
Todd Lutsky is here to answer your questions about your estate plan. Again, phone number is 888-205-2263. That is the number to call so that Todd can answer your estate planning questions live on air. Again, 888-205-2263. Let's go to Steve in New Hampshire. Steve, what is your question for Mr. Lutsky?
So my question is that I have for retirement, I have a SEP that's got a value of a little over $3 million.
Mm-hmm.
Got a brokerage account also that's a little over $2 million.
Mm-hmm.
I'm 68 years old.
Mm-hmm.
And I've been going back and forth thinking or considering switching some money over into a Roth. And I'm not convinced that that's the way I should go at this point.
Mm-hmm.
Being that I don't know that I can really convert over enough funds that's going to make the difference when it comes down to my required minimum distributions.
Okay.
And I am also still working.
Are you married?
I am.
Kids?
I have 2, yes.
Grandkids?
Yep, just one that was just born.
Okay. And so you're looking at maybe $5 million. I think the whether you flip it to a Roth or don't flip it to a Roth and so forth, I really think is more of a financial planner's question. You might want to sit with your advisor and sort of, play out whether or not it makes sense to do that and what are the taxes I'm going to pay now when I do that. But so do you have like an estate planning question in here somewhere? Like I noticed you've got a SEP and a brokerage account, so I've got $5 million. You also need your house and any other assets to determine whether or not estate planning is important, or is that not an issue?
No, the estate planning, I'm trying to figure out how this is going to work best for my estate and for my children down the road. I know if the money's in a SEP, that helps them. In a Roth, it helps them. But that's, again, secondary question.
How much are you worth altogether? House, money,
Probably,
everything.
About $7 million.
So at $7 million, again, some being qualified money, some being not qualified money. I get it. It's important to think from an income tax perspective and how it fits into your estate plan as well. So, but just in general, for someone $7 million, we're probably looking at a joint revocable trust for you. How we draft the joint trust to accommodate the SEP IRA, which is a $3 million asset, is important. And that's why I'm recommending a joint trust, because with a joint revocable trust, the $3 million can't go in there while you're alive because there's a big income tax hit. I get that. But it can get there when the death of the survivor occurs. But on the first death, I want to be able to cram down as much as I can for estate planning purposes. So if I back out $3 million from your 7, I only have 4 to deal with. Well, I want that whole 4 to be crammed down on the first death for estate taxes and not divided between a husband trust and a wife trust. So I think we're talking about the same thing here in terms of taxes, estate taxes, income taxes. But I think the joint trust would work best for you because it will accommodate both the large IRA asset, the large SEP, and your estate planning. And I don't think you're probably in a situation where you need to worry about nursing home care. You're probably self-insured with the interest and the money you can generate, the income that you can generate with your assets. And then you just need to decide how you want to leave these assets to your children, over time, from a generation skipping tax perspective, et cetera, divorce proofing it, et cetera. So hope that helps, folks. That's a great estate planning question. Let's just turn a minute for the guide, though. And one thing I didn't mention here to this caller, Steve, was that gifting was right. And the guide we're giving away is making the most of gifting assets, right? It is a guide that explains really whether you should gift or not. And again, gifting didn't seem like a huge deal for this past caller. It's not appropriate. However, for you it might be. But then you need to know how to do it. Do I give it away outright to kids? Probably not. Maybe a gifting trust. If I want to make big gifts, do I put it in a trust that I can keep control over after I give it? Well, I would want that. So a spousal lifetime access trust comes up. There's estate tax and income tax issues to consider and whether to gift at all or not. Folks, get the guide, 866-848-5699 or legalexchangeshow.com and learn how to make the most of gifting assets. 866-848-5699 or legalexchangeshow.com.
Todd, in the last segment, we were talking about, kind of things to do to potentially mitigate state-level estate taxes.
Yes.
Is the assumption if you do have a large enough estate where you have a federal estate tax liability, are you using the same tools or are there different ones that come into play based on the size and scale of an estate?
Yeah, and I think after the OBBBA, if I said enough B's in there, the new act that passed, I think it's really important to talk about those things because they left a lot of the old rules in play. And so for larger estates, and maybe a lot of times we don't speak enough about them, but for a larger estate, you're pushing close to 30 million when you're talking about larger. These folks are going to be making much bigger gifts. And gifts will matter then. Remember, before we were talking about this, $10 million estate, and I'm saying, well, wow, if you make a gift, you're really not helping to save the 40% estate tax rate. You're really only talking about the state estate tax savings, which is closer to 10, 12%. Well, that's not a huge savings. But as you bring up, Chuck, if we're talking about larger estates, now I'm not so worried about the carryover basis or the trapping of the capital gain on the assets that I give away, because now if I'm making a gift at this larger level, I am saving, the state and the federal estate tax. So that could be 52%. So let's just, for easy numbers, let's say 50%. Well, if I give away something that saves me at the 50% level and traps something at the 28% level, I guess I'm okay with that.
Sure.
And another reason I'd be okay with that when you're dealing with those big numbers is that tax when you die is due 9 months after you die. It's a hard stop. You got to pay. I mean, you could be faced with a down market. You could be faced with a fire sale on real estate to come up with the money you need to pay the tax. Whereas if I've made the gift and I've built in the capital gain, I get it. It's there. But the kids don't have to sell it 9 months after I'm dead. They can play around with that capital gain, right? They could say, well, you know what? I'll just hang on to this. As you know, from a financial planning standpoint, giving up, selling all the time isn't the right thing to do in a down market. Maybe I know there's gain there, but if I've got some losses built in, I can wait till I have losses, sell the lost items, then sell the gain items, and offset the capital gain with the capital loss. So you have a little more play with that capital gain than you do with the death tax. That's a hard and fast, hey, 9 months you got to pay. So I think that's a little bit of food for thought.
Mr. Lutsky, I appreciate you joining us today. Thank you so much for the time.
Thank you. Always a pleasure.
This has been Ask Todd on the Financial Exchange Radio Network. Ask Todd with Todd Lutsky has been presented by Cushing & Dolan, serving Massachusetts and New England for more than 30 years, helping families with estate and tax planning, Medicaid planning, and probate law. Call 800-393-4001 or visit CushingDolan.com. The views expressed in this segment are solely those of Cushing & Dolan. Armstrong Advisory does not provide any legal or tax advice. Please consult with your legal or tax advisor on such matters. Cushing and Armstrong do not endorse each other and are not affiliated.
Still more to come on the Financial Exchange. We'll be talking about the latest with the U.S. and Argentina. We'll also talk about how as the shutdown now moves into its third week, its fourth week. I was told there would be no math. Talk about what that means for the U.S. economy. And then a little bit of a Fed update. We've got a Fed meeting that's going to be taking place next week. We'll preview a little bit on what to expect there. So, again, quite a bit coming up in hour 2. Make sure you stick around.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine, no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense. Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is the Money Matters Radio Network, WBNW 1120 AM and W275 CM FM. Concord, Boston, the Money Matters Radio Network.
October 24th is National Food Day, a perfect time to celebrate fresh, local food right here in Massachusetts. Fall harvest season is in full swing with crisp apples, sweet pears, pumpkins, squash, cranberries, and hearty root vegetables at your neighborhood farmers market. Markets are still open, so grab your bag. Support local farmers and bring home the flavors of autumn. Sponsored by Mass Farmers Markets, helping grow farmers markets across the state. Find your local market at massfarmersmarkets.org.
The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping in the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. The DAV of Massachusetts has helped me and countless others adjust to civilian life through a variety of incredible programs. Through our local Veterans Assistance Program, we provide necessary services to veterans and their communities, such as food shopping, landscaping, and companionship, but we need your support. You can help by making a donation today. Please visit dav5k.boston. That's dav5k.boston.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Understanding Required Minimum Distributions. Mike, one area with some big changes the last couple of years has been RMDs as it relates to inherited IRAs. What is the lay of the land today?
Yeah, so critical things that you need to know is that for most inheritors that are not spouses, so that's your starting point. If you are not married to the person who passed away, you are most likely subject to a out in 10 rule. What has also changed is that you're required to satisfy two different rules for most folks. Again, you are required to empty that inherited IRA within a decade. You also have annual required minimum distributions based on life expectancy. So it is really complicated now for inheritors.
How does that potentially influence how a parent may leave assets to surviving children in terms of taking their incomes into account?
Yeah, well, I mean, look, it is going to concentrate this additional income in a decade time period after you're gone. And so it adds a little bit of complexity in terms of that estate planning, right? Maybe I've got two kids. One's a very high income earner. One is a little bit lower. Do I potentially reshape my beneficiaries so that they both receive the same amount, maybe after taxes? A lot of complex planning you can do there.
The guide this month is titled Understanding Required Minimum Distributions. The two ways that you can request it are by calling 800-393-4001 or by visiting armstrongadvisory.com. Again, that number is 800-393-4001, or you can request it at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Kicking things off here, it's Chuck, Mark, and Tucker with you, and nothing too exciting happening in markets today, but a little movement here and there. S&P 500 down 11 points, not even 0.25%. Dow Jones Industrial Average down 81 points, not even 0.25%. NASDAQ Composite down 101 points, almost 0.5%, so you got a little bit of movement in the NASDAQ, and we can talk about, kind of why that's happening as well. The U.S. 10-year Treasury up 0.9 of a basis point to 3.972%. U.S. dollar index is down 0.02%, so basically flat, not much movement on the dollar. Gold continuing its sell-off over the last couple days, down another 1.94% to $4,029.20. And we've got crude oil, West Texas Intermediate, up $1.38 a barrel to 58.62 at the moment. AAA national average for gas prices moving back up. Some of this due to continued refinery outages in the Midwest, but back up to 306 and 610. So it looks like, at least for this week, we're going to have to put on hold the idea that the nationwide average is going to drop below $3 a gallon. Just can't quite get there at the moment. But that is what is moving in markets broadly at the moment. Let's talk a little bit about this piece from the Wall Street Journal. It's a Wall Street Journal exclusive, and I'll quote here. Trump administration is pushing officials in Argentina to limit China's influence over the distressed South American nation. At the same time, the U.S. and Wall Street banks are working on a $40 billion lifeline for Buenos Aires. And basically, like, if you look at the reporting on this, the thinking in terms of, the question that I've asked, quite honestly, is, okay, like, Argentina, Mark, is it fair to say that Argentina has one of the worst fiscal, monetary, and governance track records out of any country that's at least stable in the last 100 years?
There is 120 or so years ago, they were as wealthy in per capita terms as the United States.
Yes, it's really the last 100 years that's kind of been the problem.
That's always the kicker, yeah.
Just a few generations.
They've been a serial defaulter, and I'm not exaggerating. That might be understating how chronically, ineptly they've managed their finances. They oscillate from a center-right government, which is, I'll characterize Malay, cut spending, get inflation under control. He's done those things. He's also pegged the peso to the dollar at what most analysts think is too high a level for the peso. Speculators are attacking it. That's why he needs dollars. They're running out of dollars to pay the IMF.
To cover the peg.
They owe $50 million. To pay foreign credit. So you need to export to get dollars, or you can get them from the IMF. That's where they got the $50 million loan from. We're apparently going to give them another $40 billion, $20 billion of which will be guaranteed by taxpayers, all in an effort to push up the value, to keep the value of the peso artificially high, which you need to do if you're an Argentinian policymaker, to keep inflation under wraps. The more pesos it takes to buy something.
Argentina is a big importer of stuff that it needs, and so when the peso devalues, it creates inflation, and it's kind of this whole problem for them.
So now this is not new. This happens every several years. This cycle of a center-right government coming in, succeeding a Peronist, which was he was the FDR with a real authoritarian bent leader of the 40s and 50s. Okay, so they oscillate from left-wing Peronist populist money-printing government to center-right government, which they have today. The center-right government pegs the peso to keep inflation under control. Speculators attack the peg. Invariably, they have to devalue. In many cases, they've defaulted. We've seen this movie many times before, Chuck.
So you mentioned, look, the U.S. Treasury is now effectively on the hook for about $20 billion in a currency swap line that's out there. But they are also trying to work with private investors to wrangle up another $20 billion, and banks are naturally sitting there kind of like, you want us to do what? Now, the rationale for this, as it's been laid out by a few people, is, hey, look, two things on this front. Number one, you want to be able to counter Chinese influence in the region. Number two, Argentina is rich in mineral resources, and if you can work with them, you can potentially provide an additional supply of some of the stuff that we get from China right now that could be held through another country, that could be produced in another country that is not as hostile to American interests. On the first one, countering China, the problem that I have there is, look, there is no long storied history of the United States and Argentina being like great partners in doing anything for the last 100 years. And because of Argentina's economic size at this point, it again is not particularly large, and we're not huge importers or exporters from them. If you really wanted to counter Chinese influence in South America, Brazil's probably the place that you would tend to look due to its size and also vast mineral resources, and like you can kind of go down the list there, and the fact that it's not Argentina. I mean, it's Brazil, which presents its own slate of problems just from a stability and governance perspective, but those are far different problems from what Argentina faces on a fairly regular basis. So I think you're left kind of looking at this saying, hey, the upside on this, if it were to work, is, yes, you potentially, start to unlock another trading partner in the region, but, like, gosh, I mean, it really doesn't seem like that's a long path. I mean, this is something that's not going to be achieved in any sizable way in the next 3 to 5 years.
Yeah.
Like this is a multi-decade project to stabilize Argentina.
Milei's party is facing elections in several days, which is
Yes.
the reason they're desperately trying to keep the peso at
They
its
don't want
current
inflation
level
before the election.
Well, if there's a massive, if they let the peg go, and it's a crawling peg, so it goes up and it's not a firm peg, it moves.
It's an intraday range.
The band expands by like 1% a month or something. So they are letting the peso go down,
Yeah.
only in an orderly way. If there's a massive successful attack in the peso before then, it could be destabilizing and will certainly further sour Milei's party's electoral chances in the regional elections coming up in a few days. So we're just trying to desperately get him to hold on for the next few days through these extraordinary efforts, in addition to the swap line, which is technically a loan, but they could default on the loan.
Correct.
That's where the risk is.
Yes.
Right? We've also bought like $500 million in pesos directly, the U.S. Treasury has. So we're on the hook for an increasing amount of money here for unclear, very unclear at this point, political gains. The regime in Argentina could change soon, and we could end up with a party effectively ruling the state because Milei will become neutered. If opposition takes Congress, their equivalent of Congress, they may not be friendly to us. So far, as far as I know, we've got no assurances, never mind a written agreement for rare earth minerals or anything along those lines, right? Or am I overlooking
Correct.
something?
And so the problem here is China does have deeper ties with Argentina economically than we do. They are the second biggest trading partner of Argentina behind Brazil. So Argentina, on one hand, is kind of like, hey, we can't just stop that because we don't do anything with the U.S. in any sizable scale right now. And that's kind of a problem if you can't commit to fill that gap from China at the moment.
Again, there's no political consensus in Argentina to move closer to us. You need that. Milei is powerful. The chief executive there is powerful, but he's not a dictator.
Sure.
And if power continues to tilt toward the Peronists, the left-wing, progressive, print a lot of money, be reckless fiscally party, as it always has historically.
Correct.
The center-right president, Milei now, Macri before him, has imposed reforms. Those reforms generate pain. People tolerate it for so long, then they get sick of it. They throw the center-right government out. They swing back toward the Peronists. It's no different than people here switching from Democrat to Republican based on sentiment. They're feeling about how the economy and how they are doing personally. So without any assurances that there will be consistency in dealing with the U.S. as a result of us putting $40 billion effectively on the line, because we're going to backstop the big banks if they hop on this wagon with us. We have to. I say we have to. It'll be informal, but presumably we're not going to let a big bank go under because of a bad bet in Argentina, which
you wouldn't expect. It wouldn't be big enough for them.
I don't think so. But if
it shows up on an earnings statement, it's like, hey, what's this? Well, Argentina. What are you going to do?
Nothing anybody a person of sound mind would do of their own free will. That's insane. You're throwing good money after bad. Sorry.
There's a reason why the big U.S. banks don't normally take $20 billion and be like, hey, Argentina, we're willing to lend this to you.
Chuck, Argentina has not been able to tap global capital markets for almost a generation. I think since 2003, they're viewed.
I think they've had either 2 or 3 defaults since.
They've had 3 this century, I know,
so
and
3,
then several in the preceding 50 years. They're on the hook for another $50 billion, as we talked about earlier, from the IMF. I'm sorry, we wish them well, but
it's kind of like if you've got that member of your family who they're great, you love them, but they're just not good with money. And every time that you make a loan to them, it's really a gift because you're not getting the money back.
Yeah.
That's effectively what Argentina is from an economic perspective. It's not that you don't want to help the people or help to promote stability there. It's just there's no track record of the money being able to be utilized in any fashion that promotes stability or the ability to pay it back.
And there's nothing remotely analogous to a familial tie here either. We export very, very little to Argentina. We did the same thing for Mexico, by the way, 30 years ago.
Sure.
In the mid-'90s, we used money from the Exchange Stabilization Fund, which is what the Treasury's doing. It's a kitty, effectively. They swapped pesos, Mexican pesos at the time, for U.S. dollars. Mexico returned the dollars at the exchange rate at the time of the deal, so it was a loan that was paid back in full, and it worked out. But The circumstances there, as I was talking about with Mike yesterday, are very different. Mexico is a much bigger trading partner, like 20x bigger.
Right.
And we, of course, share a border with Mexico. So a failed state Mexico is in nobody's interest. Argentina, harder to make the case.
Quick break here. When we return, we've got trivia next.
Hear the Financial Exchange every day from 11 to noon on SiriusXM's Business Radio Channel 132. Keep it here for the latest business and financial news and the trends on Wall Street. The Financial Exchange is now live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing & Dolan want to help you avoid costly mistakes when it comes to gifting assets to your children. Their brand new guide, Making the Most of Gifting Assets, shares crucial strategies to help you protect your legacy and your family. Many people think gifting is always a good thing, but if it's done the wrong way, it can create real headaches. Even well-intentioned gifts can cause complications if your children are dealing with financial pressure or legal issues like a divorce. The guide also explains how a major gift, like a home or vacation property, could come with hidden tax consequences that may impact your entire estate plan. Before you make any big moves, arm yourself with the facts in this new guide from Cushing & Dolan. Call 866-848-5699 right now to get your copy. That's 866-848-5699. Or request it online at LegalExchangeShow.com. That's LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
The Financial Exchange streams live on YouTube. Subscribe to our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
All right, time for trivia here in the Financial Exchange. And on this day in 2016, AT&T agreed to buy Time Warner for $85.4 billion. The purchase by AT&T came 16 years after Time Warner engaged in a famously failed merger with an internet provider company. So, trivia question today. In 2000, which internet company merged with Time Warner? Once again, in 2000, which internet company merged with Time Warner? Be the seventh person today to text us at 617-362-1385 with the correct answer, and you win a Financial Exchange Show t-shirt. Once again, the seventh correct response to text us to the number 617-362-1385 will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Piece from the New York Times. Shutdown with no clear end poses new economic threat. And I don't think I'm quite there yet. I think that's... I'm just not there, quite honestly. But here's what I will say. The longest shutdown that we've ever had was 34 days at the end of 2018. And you see all these estimates that are out there that, hey, for each week the shutdown goes, it's maybe a 0.1 to 0.2% hit to GDP. And I find those estimates kind of funny, to be honest, because most shutdowns last anywhere from 1 to 6 days, and so, like, how do you even measure the impact of like a 3-day shutdown?
That's
You
the key problem.
you can't accurately
That's right.
do it.
That's right.
Beyond that, I think that there are some compounding forces at work here that mean that this doesn't move in a linear fashion, in that a 1-week shutdown relative to a 2-week shutdown might be, half as bad, but an 8-week shutdown might not be 4 times as bad for the economy as a 2-week shutdown. It might be 10 or 15 times, because here's the thing.
Yeah.
We talk about like government workers that are furloughed, and it's like, okay, you're going to get paid when you come back to work for that work or for that lack of work. Government contractors don't work the same way. If you are a private company that contracts with the federal government that doesn't have work going on, so you're not being paid by the federal government and you are not paying your workers, a couple things happen. First, you're probably not going to end up paying your workers for that time anyways, because you're not getting paid anything for work that you didn't do. You are a contracting firm, not a firm that is being paid, an hourly rate as an employee. It's different. Like you have a fixed government contract to deliver X, Y, and Z. You are not delivering it during that time. The federal government does not make you whole. If that's the case, those contractors, if it's a 2 or 3 day window, nothing happens. If we're sitting here, and I don't think we will be, but who knows, if it's been 60 days and 80% of your work comes from government contracts and you haven't been paid then, how are you making payroll? Do you make the decision to lay people off or close your doors? These are the things that can happen as things go longer. So I think it's fair to say that to this point, quite honestly, the economic impact in the aggregate is really minimal. I don't think there's much meat there. If we're sitting here at Thanksgiving and this thing is still going on, I don't know exactly what the impacts look like then, and I suspect that they move up in a fashion that looks more like an exponential curve than just a linear weekly progression.
Yeah, I think this is, you just, encapsulated in the way you just phrased it right there, the problem that comes, that attends trying to model something like this. We never hit the part of the relationship where it changes.
Correct.
So we don't know how to estimate what the relationship, I'm doing a little curvy thing with my hand.
I know, it's great for the radio listeners.
Yeah. But I don't think I could add anything to the way you just said it, where other than to say that we, as an analyst, I have no way of telling you what the relationship should look like beyond a certain point, because you're effectively in uncharted waters.
And we also don't know where that point is. Like
Good point, too.
It's
It could
those
be at
2
2
things.
months or 3 months.
It might be at 45 days. It might be at 90 days. Don't know where that point is, and don't know what happens after it. So,
other than that, nothing to worry about.
Well, it's like, how can you worry about it?
No, you
can't. It is, to quote, I believe it was Donald Rumsfeld, it's an unknown unknown. You know?
Yeah, it is. Do you sense that people are complacent? Market's been up. The president seems to like the shutdown because he's ruling
from an
solo.
economic perspective, no one in the aggregate cares.
Yeah, you're
now,
not.
if you're listening to us and you're a government contractor or someone who's furloughed and you're not getting paid, you're sitting there, you're like, Chuck, this matters to me a lot. I hear you. I get that. I'm not saying it doesn't matter to individuals. What I am saying is that in the aggregate to this point, the economic impact has been minimal. But the longer this goes on, the bigger the chance that goes from being minimal to meaningful to significant.
Yeah, and the rub here is that we won't be able to extrapolate from this experience probably. Like suppose after day 65.
They're all different.
Everything yeah, I don't know that because the sample is so small we'll be able to take anything away from this.
Current estimate on internet betting markets, this one from Kalshi, is the shutdown is the over-under right now is 40 days. Is where we are. We'll see. Quick break here. When we return, we've got the trivia answer and Wall Street Watch.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. If you're approaching your 70s, you might be thinking about slowing it down, but the IRS is just getting started. Required minimum distributions, or RMDs, kick in starting at age 73. And if you were born in 1960 or later, that number jumps to 75. RMDs are more than just a box to check. They can impact your taxes, your income plan, and even what you leave to your heirs. If not done properly, it could mean big penalties, but getting them right might help keep your money working for you. Our latest guide, Understanding RMDs, breaks down how they work, when to take them, and strategies that may make them less of a tax headache and more of a financial opportunity. Request your copy today by calling 800-393-4001 or by visiting ArmstrongAdvisory.com. That number again is 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands aren't just stunning, they're thriving and continue to be one of the hottest spots for vacationers in the Caribbean. New cruise port upgrades, better air connections, and a sharper focus on cultural experiences are putting the islands back on the map for travelers seeking something special. St. Thomas is your cruise hub, known for duty-free shopping and the world-famous Megan's Bay. St. John is pure escape with national park hikes, secluded beaches, and tropical tranquility. St. Croix brings the history with colonial architecture, old sugar mills, and vibrant coral reefs. Visit one island or all three and get plenty of pampering, undisturbed nature, and a vibe like no other, all jammed into one vacation. With easy travel from New England, no passport required, and no money to exchange, paradise is closer than you think. This fall, plan your getaway and fall naturally in rhythm with the heartbeat of the islands in America's Caribbean. Visit usvi.com and book your trip today. That's visitusvi.com.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served nearly 20 years, and we are so proud to have him and his business as a key partner and a presenting sponsor of the DAV 5K Boston. The DAV Department of Massachusetts does incredible work, and it's one of the first organizations that Marc became familiar with after his military service ended back in 1984. As Marc built his company, he knew he'd be giving back to fellow veterans who needed jobs, support services, medical supplies, and so much more. Marc works with disabled veterans every day, and it's one of the key reasons why he's such a big supporter of Dan Stack, the DAV Department of Massachusetts, and the DAV 5K Boston. You can join Marc Vonner and his team and make a donation to the DAV Department of Massachusetts or become a sponsor of the DAV 5K Boston. Simply visit dav5k.boston. That's dav5k.boston.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutsky, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about the implications of gifting assets away. Todd, since the estate tax laws are projected to change on January 1st of 2026, significantly reducing the estate tax exemption, does it make sense to gift away assets right now?
You know, it's a big question mark. You have to think of a few things. One, look at the size of your estate. If the exemption falls to $7 million each and you're married, you can still die with $14 million of assets and not have an estate tax. So gifting might not be important from a federal gift tax situation. But the state exemption is only $2 million, so you can only shelter $4 million. So you might want to gift to reduce your state estate tax. However, there's basis to consider. If you give away low basis assets, you're trapping capital gain. And to do that, you might be paying more in capital gains taxes later when the kids sell the assets than you're saving in just Massachusetts estate tax. So you really got to think about whether it makes sense to gift or not. And if you're going to gift, you should probably set up a gifting trust. People might be gifting large assets away and not gift the assets directly to a child. Have them in a trust for the child's benefit and then protect those assets for them.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy from their website, LegalExchangeShow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, as third quarter earnings season continues to chug along, markets are now in negative territory. The Dow down by 135 points or 0.3%. S&P 500 is down nearly 0.5% or about 30 points lower. NASDAQ now selling off nearly 1% or 218 points at the moment. Russell 2000 down 1.3%. 10-year Treasury yield is flat at 3.966%, and crude oil up about 2% higher, trading at $58.36 a barrel. Netflix reported third quarter earnings that disappointed while its revenue matched street estimates. The streaming giant cut its expected operating margin for the year to 29%, citing an expense related to a dispute with Brazilian tax authorities. Netflix shares are down about 10%. Following up on a developing story where CNBC is reporting that Warner Brothers Discovery rejected 3 Paramount Skydance offers as it fields broad buyout interest. Yesterday's reports said Warner had received unsolicited interest from multiple parties. Warner Brothers shares are up about 1%. Meanwhile, Beyond Meat is the latest meme stock with wild gains this week. Yesterday, shares in the plant-based meat alternative company rocketed 140% higher after it signed a deal with Walmart to expand distribution. Earlier this week, Roundhill Investments added the stock to its meme stock ETF. Shares are quite volatile today, now up 29%. Today, it's at its GM Forward event. General Motors announced a suite of new software initiatives for its vehicles over the next 3 years, including an in-vehicle AI assistant from Google and a driver assistance system, which will allow drivers to be hands-free and take their eyes off the road under certain circumstances in 2028. GM is up about 0.5%, and after today's close, we'll see earnings from Tesla. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked the trivia question. In 2000, which internet company merged with Time Warner? That'll be AOL. Robin from Elliott, Maine is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Robin. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Tucker, at the time that you were talking, Beyond Meat went from being up 29% to up 15%.
And last hour is up 100%.
Just to give a sense of the volatility there. This, by the way, is a company that in Q4 of 21 had done $464 million in revenue in the prior 12 months. It now has done $301 million in revenue in the prior 12 months, so revenue is declining at about a 10% a year clip. The company is free cash flow negative to the tune of $125 million in negative free cash flow in the last year and has $100 million in cash on hand. And yet you're seeing this kind of activity. To me, it says only one thing. Fed's got to hike.
Yeah, it is a tribute. I know you're being half
I'm only
facetious.
being like 20% jokingly silly.
No, I said the same thing a
this.
couple times yesterday, and Mike Armstrong probably just zones me out at this point. But yeah, it is symptomatic, Chuck. If you look at the bankruptcies by lenders who are making loans they shouldn't have been making, you look at record high stock prices, you look at the until very recent massive run up in precious metals. There are a number of symptoms, including financial conditions, which the Fed does directly control. We have indices that measure those. They're at all-time accommodative levels. Go ahead.
Do those financial conditions measures suck?
Well,
like,
they're
are they
not.
like?
No, I know what you mean. I know
Isn't
exactly
a
what
big
you
portion of it just like, hey, are stocks up or down?
Well, stocks are part of the index, but they're acutely aware of the feedback, and
right?
The circular reasoning that could result from that feedback. So they have to be part of it because the Fed looks at it, and when stocks go up, firms do have more capital. That's the whole point of going public,
right?
But there's other stuff in there too: bank lenders,
sure.
stringency or liberality. By that, how willing they are to extend credit, stuff like that. So I guess you could even throw that out because it's problematic. But by any measure, financial conditions are quite accommodative. Markets are very frothy. The word bubble's getting... Now, that we may not be in a bubble being circumstances whereby prices are so far removed from fundamentals they couldn't possibly be justified by a serious person using a computer under any circumstances.
Well, you don't know if you're in a bubble until...
That's what I mean.
Yeah,
I'm not passing judgment. I'm just saying you hear the word a lot, but you don't know until after the fact.
Sometimes you do know during the fact, actually. Like in 2021... Got to say, we called it. We were like, hey, all these SPACs are getting out of control. We got, Trevor Milton pushing,
That's so fringy, though.
No, but we were like, listen, there is, like, what's happening in EVs looked bubbly.
Yeah.
And it turned out it was.
Yeah.
Because you had companies that had never made a vehicle.
Fair enough.
They were being valued at like $50 billion.
Okay.
And you're like, guy, this is kind of a problem. Today, if you want to know where it is, it's some of the AI adjacent stuff.
Fair enough.
I won't even say like AI. But the stuff where it's like, hey, we're going to maybe make small modular nuclear reactors and we've never made one, and we're valued at tens of billions of dollars.
Okay, so you can have little bubbles like pockets.
Micro bubbles.
I'm talking about, that's fine. That's actually a great way to think about it. So you just described a few that are so detached from any reasonable estimate of present value of future cash flows that, it's probably a bubble. I'm talking about the broad market, but people are throwing the word bubble around with respect to the stock market as a whole because so-called Shiller PE and other measures of price to long-term inflation-adjusted earnings are nearly as high as they've ever been, the only comparison point being the so-called .com bubble. So by any measure, Chuck, things look quite frothy. And underlying inflation, trend inflation, I use median for that because it's the go-to metric for researchers. There are others, though, measures of the trend in inflation that filters out the noise attendant with month-to-month data that point to ongoing elevated inflation. So it's a little odd, unless you have a very strong belief, which Fed Governor Waller does, as one of the stories in our stack talks about, that the labor market is weakening quickly. Unless you have very high confidence in that belief, it's unclear why the Fed should be easing.
Folks, the Armstrong Advisory Group has a guide available this month. It's titled Understanding Required Minimum Distributions. Good old RMDs. Well, if you've got questions about RMDs and your financial situation, this is the guide that can help give you some answers about whether or not you need to take RMDs, about how big those RMDs may or may not be, and what can the penalties be in the event that you don't take an RMD when you're supposed to. There are little less than 70 days left in 2022. 2022. Tucker, can you hit the reset button on me or something? What just happened?
+3.
Did I just glitch back 3 years?
A little bit.
My goodness. There's only about 70 days left in 2025. Thank you very much. And so in order to make sure that you've got things buttoned up, this guy is a great place to start. Again, it's titled Understanding Required Minimum Distributions. The rules surrounding them have changed a number of times in the last 5 or 6 years, and this guide can give you some of the information to help make decisions for yourself about, do I need to take an RMD this year? How much is it going to be? And what do I do then? The guide, again, is titled Understanding Required Minimum Distributions. There are 2 ways that you can request it. First is by going to ArmstrongAdvisory.com. There's a button there where you can request it. Second, you can call 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Mark, I want to skip ahead and talk about health insurance here, just because Tucker put a couple health insurance pieces in the stack, and I don't want to just save them for stack roulette. I'm going to start with this Wall Street Journal one. The average cost of a family health insurance plan is now $27,000. That's according to the Kaiser Family Foundation. And I have a few different thoughts about this. The first is, everyone loves to hate insurance companies, but no one ever says how they would fix it or run an insurance company themselves that would be better. I'm not saying that insurance companies are great, rah-rah, yay insurance, but what I am saying is, okay, tell me how you would fix this so that things are cheaper, and most people can't actually do that. The problem that we have, in my opinion, is not that health insurance is too expensive, it's that incomes are too low relative to overall healthcare spending. And specifically, when you look at healthcare spending as a percentage of GDP,
That's right.
It's been on a freaking rocket ship for the last 40 years.
Yeah, you're right.
It's just gone up and up and up. So it's a bigger portion of our spending is going towards healthcare.
Yeah.
And it's not happening with improvements in outcomes the way that you would expect.
Nope.
It's not like lifespans have
Right.
dramatically
Right,
increased during that time.
Right.
And so the place where I get to on this is, and again, people have looked at trying to fix this, and everyone basically comes to the same conclusion, which is don't know what to do, but it's a mess. Because you basically have this hybrid of, let's take the worst parts of public healthcare and the worst parts of private healthcare and put them together, and that's what the U.S. healthcare system basically looks like. It's, hey, we have to expand coverage to cover more people, but we're not going to do anything to increase the supply of doctors because, I forget if it's the American Medical Association or whoever it is, it's one of the big doctor groups, limits the number of med school residency spots that you have, and so you can't get enough doctors that are trained, which means, Mark, according to supply and demand, if you increase demand for healthcare but don't increase supply for healthcare, what happens?
Prices should go up to ration.
And they tend
services.
to. Okay? And so you have, and that's just one example, but basically what you have, you've got a whole mess. It's not the insurance company's fault that these prices are this high. It's the overall system as a whole is why this is happening, because there is nothing out there that says, hey, here's how we're going to make sure that, pricing is being, effectively implemented. There's not enough competition in many states. You look at the New England region where our show is based, just as an example. You have one or two large conglomerates that basically run healthcare systems now, and there's not a ton of competition out there on pricing and things like that. And it's just a very messy situation. So it's not to say insurance plans are properly priced to get over it. What I'm more saying is, no, this is a problem, but the insurance cost is the symptom of the problem. It's not actually the cause of it.
No, you're absolutely right.
It's not the cause of it.
Yeah. We spend twice as much. I'm just dividing here personal consumption expenditures. That is spending on healthcare, dividing that by total spending. We spend about twice as much as we did in 1980 on healthcare today. And as you point out,
and we don't live twice as long.
We're advancing
which we wouldn't expect to.
Yeah, yeah, you're absolutely right. The gains we're making are, I'm sure special, healthcare economists would say, no, you're getting this all wrong in terms of terminology. But the gains we're making are really, really incremental. We're picking up, inches here as opposed to yards in earlier waves of innovation.
And this is also before we even get to the issues with, we're talking now about improving quantity of life in terms of lifespan. Are we seeing, what are we seeing in terms of quality of life? Even for folks who may be living longer, is the quality diminished because of, X, Y? I don't even know how you measure it. So let's take a quick break, and then when we come back, let's do Stack Roulette and talk about something more uplifting than $27,000 for health insurance.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network. Cushing & Dolan know that gifting assets can be one of the most emotional and challenging parts of estate planning. Their new guide, Making the Most of Gifting Assets, can help you learn what to consider before making a major gift, like your primary home or a vacation property, and avoid unintended tax problems. Call 866-848-5699 to get your copy, or request it online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Marc Vonner is the CEO of Veterans Development Corporation. Marc is a career military man, having served for nearly 20 years, and we are so thrilled to have him and his company as a key partner and the presenting sponsor of the DAV 5K Boston. Marc comes from a proud military family, including his father Victor and his brother Timmy. Marc talks often about how serving his country was one of the greatest achievements of his life, and that's one of the key reasons that he chooses to give back to this special community. Marc is honored to continue his legacy that his father started when he built Veterans Development Corporation. Working to help many disabled veterans and their families has become a lifelong goal for Marc, and it's why he's taken the time to fully support the DAV Department of Massachusetts. You can join Marc Vonner and Veterans Development Corporation and help our great American heroes today by making a donation or becoming a sponsor. Simply visit dav5k.boston. That's dav5k.boston.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Turning 70 isn't just another birthday. It's when the clock starts ticking on your retirement withdrawals. At age 73 or at age 75 if you were born in 1960 or later, you need to start withdrawing money from your IRA. They're called required minimum distributions, and missing one can mean big penalties. Taking the RMDs at the wrong time can also spike your tax bill. Even the type of account matters, since your IRA and 401k follow different rules, which could get confusing fast. Our new guide is called Understanding Required Minimum Distributions. It breaks the process down in simple terms so you know when to start, how much to take, and ways to manage the tax impact. Request your copy today by calling 800-393-4001. That's 800-393-4001 or ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's The Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you by the U.S. Virgin Islands Department of Tourism. Looking for a getaway that's easy, warm, and unforgettable? Discover the magic of the U.S. Virgin Islands, St. Croix, St. Thomas, and St. John. Just a short flight from New England with no passport needed and no money to exchange. Soak up the sun, stroll along white sand beaches, and feel the rhythm of the heartbeat of the islands. The USVI is America's Caribbean paradise. Plan your fall escape now at visitusvi.com. That's visit usvi.com.
Mark, I got to start off with a piece that I just found a little while ago. You guys, what just happened?
What?
Oh, sorry, my sound is...
You can't hear anything?
No, you...
Oh, I can hear you loud and clear, so don't worry about
something. Maybe I just leaned the wrong way or something.
No, I hear you, babe.
Okay. Anyways, you guys remember the AWS outage from Monday?
Oh, yeah. How could you forget?
Did you have your sleep disrupted by it?
No.
It's interesting because there's a company by the name of 8 Sleep, and I wasn't familiar with them before this.
The number 8?
Yes.
Or 8. You 8 Sleep? Okay. Yeah.
Well, like 7, 8, 9?
Yum.
Anyways, it's this company called 8 Sleep, and what they do, they make this little portable thing that sits next to your bed, and then a cover for your bed, and it can heat and cool your bed to the right temperature if you're a hot or cool sleeper.
Cool.
It's a smart bed. And this thing, by the way, costs, for, a king-size bed, it's $3,300. Not for, the mattress or the bed or anything. This is the cover and the cooling thing.
Okay.
But it basically then monitors and heats and cools as you need. I don't know that this is useful in any way, shape, or form, but it's a product and so it exists. When AWS went down, these smart beds run on AWS. And so basically whatever setting things were stuck on is the one that it just ended on. And so these smart beds pretty much ended up either overheating in a lot of cases or overcooling, and so people were just either freezing or so hot.
No in between.
And it obviously then gets to the question of, okay, if a simple AWS outage can turn your smart bed into an oven, I don't know that we're quite ready for self-driving cars that use cloud-based technology to be driving us around here. I'm just not sure I'm comfortable with it.
Seems like we should, slow down a little bit on this whole
if your smart bed
process
is being bricked by an AWS outage, maybe we should just take it a little slower on the whole self-driving vehicles thing.
I mean, there are appliances that operate on Wi-Fi technology, too.
I'm sure that some of these...
fridges and ovens, or washing machines, for some reason, they have to have internet connectivity.
Honestly, why does everything need to be connected now? Now, I understand, some things, but here, washing machines is a great example. Unless, I can push a button and have the laundry move from the washing machine to the dryer,
right? Which
would be useful.
That'd be nice, actually.
What do I need, my washing machine on my phone for? Am I going to be run it again? No, that's kind of dumb.
You know how long your wash takes.
Oh, hey.
So just set a timer on your phone.
I'm going to be home in a little bit. Turn the oven on. Gee, that seems kind of dangerous. Being, on the road, you're not home, and you're just turning the oven on. Maybe you shouldn't do that.
Yeah, just wait.
Right, there's stuff that you can do on all this. Now, there are other things that I think could be, useful from a smart technology perspective. But, my fridge doesn't need to be connected to the internet.
Well, you got to see if you have milk in there or not, Chuck.
Why don't I just use my eyes and my hand? I can open this thing called a door and be "Hey, milk, you there? Oh, you're not? I'm gonna go out and get one of your friends." We're done for the day. We do have Tesla earnings after the bell today, so we'll be covering that on tomorrow's show. And can't wait to see you all then.